Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Haas Sustainable Infrastructure Capital, Inc. Annual Report. Haas Sustainable Infrastructure Capital, Inc. offers a diverse range of businesses and services through its subsidiaries. The company's portfolio includes equity investments, commercial and government receivables, real estate, and debt securities. Its investment focus spans various sectors such as energy efficiency, renewable energy, and sustainable infrastructure. The company invests in climate solutions that reduce energy usage or cost through projects like Behind the Meter, which involves the distribution of energy-saving systems for heating, ventilation, air conditioning, lighting, and energy controls. Additionally, it invests in Grid Connected, a platform that deploys cleaner energy sources such as solar, solar plus storage, and wind to generate power production. Beyond the power grid, Haas Sustainable Infrastructure Capital, Inc. also invests in fuels, transport, and nature, which includes infrastructure assets designed to reduce emissions and provide environmental benefits. This encompasses transportation fleet enhancements, ecological restoration, renewable natural gas plants, and other projects that promote sustainability. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what could cause a stock price to increase significantly in the past year. The stock price of Haas Sustainable Infrastructure Capital, Inc. has increased significantly in the past year due to several factors. One major reason is the company's strong financial performance. A consistent track record of revenue growth and profitability can attract investors and boost the stock price. Additionally, the company's expansion into new markets or sectors can also contribute to its increasing stock value. Another factor that could have contributed to the increase in Haas Sustainable Infrastructure Capital, Inc.'s stock price is the growing demand for sustainable infrastructure investments. As more companies and governments focus on reducing their carbon footprint and investing in environmentally friendly projects, the demand for sustainable infrastructure funds like Haas Sustainable Infrastructure Capital, Inc. has increased. This increased demand can drive up the company's stock price as investors seek to capitalize on this trend. Furthermore, a strong management team and leadership can also play a significant role in driving up the stock price of a company. If Haas Sustainable Infrastructure Capital, Inc. has appointed experienced and skilled leaders who have a proven track record of success, it could attract more investors and boost the stock price. Lastly, changes in market conditions or regulatory policies can also impact the stock price of a company. For instance, if there are new tax incentives or subsidies for sustainable infrastructure investments, it could increase demand for Haas Sustainable Infrastructure Capital, Inc. services and drive up its stock price. In conclusion, the significant increase in Haas Sustainable Infrastructure Capital, Inc.'s stock price over the past year can be attributed to a combination of factors including strong financial performance, growing demand for sustainable infrastructure investments, effective management team, and favorable market conditions. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in various sectors can be attributed to a combination of factors. On the growth side, infrastructure development, renewable energy, market demand for climate solutions projects, and government policies supporting sustainability are key contributors. Additionally, domestic manufacturing resurgence, electrification of everything, inflation concerns, and recognition of climate changes, financial costs have also driven revenue growth. On the decline side, changes to net metering policies, elimination or reduction of benefits under these rules, existing electric utility industry regulations, and government or internal utility regulations favoring electric utilities are major drivers. Adverse weather conditions, climate change impacts, natural disasters, and unfavorable weather and atmospheric conditions have also led to revenue declines. Other factors that impact revenue growth or decline include interest rates affecting asset value and profitability, liquidity of assets impacting business operations, delinquency, foreclosure, and loss of investments, as well as third-party contractual arrangements exposing projects to risks. Net income and profit margins experienced significant fluctuations between 2023, 2024, and 2025. In 2023, net income increased by $4 million compared to the previous year. However, in 2024, it decreased by a substantial $15 million, reaching $203,628. The trend continued downward in 2025, with a decrease of another $15 million, resulting in a net income of $188,236. Profit margins also underwent significant changes during this period. In 2024, profit margins stood at 6.8%, but plummeted to -6.8% in 2025. This drastic decline was largely due to increased corporate tax rates and higher credit loss provisions. The reduced corporate tax rate on distributed net income as a REIT initially contributed to an increase in profit margins, but this effect was offset by the increased corporate tax rate on all net taxable income as a taxable C corporation. Several factors contributed to these changes in net income and profit margins. Increased borrowing costs and reduced cash available for distribution were significant concerns. Impairment charges on equity method investments and real estate also had a negative impact. Additionally, inaccurate gain on sale of receivables and debt securities due to incorrect fair value determinations further exacerbated the decline in net income and profit margins. On the other hand, interest and rental income increased due to a larger receivable and debt securities portfolio and higher interest rates. Management fees and retained interest income also rose due to increased fee-generating managed assets. Origination fee and other income increased due to fees earned from originating assets on behalf of co-investment structures. However, these positive trends were not enough to offset the negative effects of increased borrowing costs, impairment charges, and inaccurate gain on sale of receivables and debt securities. Overall, the fluctuations in net income and profit margins between 2023, 2024, and 2025 can be attributed to a combination of factors, including regulatory changes, increased borrowing costs, impairment charges, and inaccurate accounting practices. The company's financial performance indicates a consistent generation of positive operating cash flow over the past few years. As shown on multiple pages, the company has consistently reported positive adjusted earnings and operating cash flow across various periods. Specifically in 2024, the company generated $278 million in operating cash flow, page 50, with positive operating cash flow also reported on pages 56, 57, 58, 74, and 90. Furthermore, the company's cash provided by operating activities has been steadily increasing over the years. In 2023, it was $100 million, followed by $6 million in 2024, and then $167 million in 2025, page 61. Additionally, the company's net operating cash flow for 2024 and 2025 is reported as $1,432,191 and $1,219,118 respectively, pages 70. These figures demonstrate a clear trend of positive operating cash flow generation by the company over the past few years. The company's debt level and interest expenses have undergone significant changes over the past few years. In terms of debt level, the average balance has increased from $3,437 million in 2023 to $4,273 million in 2024, and further to $4,810 million in 2025. This represents a substantial increase of $749 million. The available capacity under the unsecured revolving credit facility also saw an increase from $1.8 billion to $1.825 billion. The interest expenses have also seen a notable rise. In 2023, the interest expense was $171 million, which increased to $281 million in 2024 and remained relatively stable at $283 million in 2025. The net change in interest expense from 2024 to 2025 is plus $50,040. However, there are some instances where interest expenses have decreased, such as a decrease of $6 million from $10 million in 2024 to $4 million in 2025. Despite these fluctuations, the overall trend suggests an increase in interest expenses over the past few years. The performance of segments and regions, a review of the recent market trends, reveals that certain segments and regions have shown significant improvement. One notable example is the United States, where performance has been strong, page 28. This region has demonstrated a positive trend, indicating growth and stability in its market. Unfortunately, there is limited information available on which regions or segments have underperformed. Further analysis would be necessary to determine areas that require improvement. The management is optimistic about the company's future prospects, driven by its strategic focus on renewable energy investments. The company has made significant strides in this area, including investing in wind and solar power projects, and has also implemented various techniques to manage interest rate risk. Additionally, the company has entered into agreements to issue senior notes and secured debt, which will help to strengthen its financial position. The management is confident that the company's operational strategy, centered around project development and investment in green projects, will yield long-term benefits. The company's commitment to environmental sustainability is evident in its efforts to mitigate environmental risks through third-party expert reviews and insurance coverage. Furthermore, the company's governance structure, including a strong board of directors and retirement policy for employees, ensures that the company remains focused on its core objectives. Overall, the management's outlook suggests that the company is well-positioned for growth and success in the renewable energy sector. The company's strategic initiatives, financial management, and operational focus will likely drive future performance and contribute to its long-term sustainability. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company invested $2.3 billion in 2024 and a further $4.3 billion in 2025. Additionally, it invested $488 million in portfolio assets in 2025. In contrast, the company has also engaged in several divestitures. One notable example is the termination of its REIT election effective January 1, 2024. Furthermore, the company disposed of certain assets, although this was mentioned as a potential consequence rather than an actual event. The sale of these assets resulted in a loss of $294 million in 2025. The company has also redeemed OP units, with 157,046 units being redeemed during the year ended December 31, 2025, and 10,000 units being redeemed during the year ended December 31, 2024. The company's financial activities have been marked by a commitment to shareholder value. One key aspect of this is the payment of dividends, which has been confirmed through documentation on pages 111 and 116. The records show that the company has indeed paid out dividends in the amount of $1,918,000. In addition to dividend payments, the company has also engaged in share buybacks. This is evident from page 102, where it is stated that stock repurchases have taken place. By buying back shares, the company aims to increase its ownership stake and potentially boost shareholder value further. That concludes the financial summary for Haas Sustainable Infrastructure Capital Inc. Feel free to comment below, and I will be happy to answer them when possible.